Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we're going to be taking a look at Blackrock stock. This one came in by request down in the comments section of one of my other videos. If you have a request of a stock you'd like me to take a look at on the channel, put it down in the comments. I will get the ticker on the whiteboard behind me and eventually I will make a video. If it's a stock that's in the S&P 500 like Blackrock, I post those on YouTube for free. The rest I post over on Patreon if they're not in the S&P 500 at the $5 tier a month level. I also have a free tier over on Patreon where I post all these videos that I post on YouTube along with some extra bonus coverage sometimes. And then you don't have to use the kind of YouTube algorithm to make sure you get to see when my videos come out. And you can search all my old videos and stuff, old analysis over there as well. So make sure to check out those links down in the description. You can also get, if you join the $5 tier, you can get a big discount if you ever decide to join the full Cyclical Investors Club service over on Seeking Alpha. And with that, let's get into the analysis. As always, this is not individual stock advice. This is just how I analyze stocks. And I have owned Blackrock before, so I'm pretty familiar with it. So this is Asset Manager. They're very big now. $137 billion market cap. So historically, if we look at the earnings, which is this dark green shaded area on Fast Graphs, I do have a 25% off affiliate link for Fast Graphs down in the description if you ever want to try it out. They have free trials over there. Use it for most of my analysis, especially if it's an earnings-based analysis like this one is. Okay, so the first thing I want to look at is earnings cyclicality, which is this green area here. So they were moderately cyclical back during the Great Recession, earnings-wise, and they were also moderately cyclical during the bust phase of the boom-bust cycle recently. But the stock price is more deeply cyclical. So we have a we'll call it a 60%, maybe 65% drawdown, which is more than 50%, which is pretty deep. And we also have, granted, this is probably coming off a higher, let's see what the PE was. Actually, it was like a 30 going into the Great Recession. 25 going into the, remember, this is not an actual recession. This is just a bust coming off the stimulus. It was probably down almost 50%, we'll call it. And then during the crash in 2020, which is when I bought it in March of 2020, it's down almost 40%. So moderately cyclical earnings, and I would call it a pretty deep cyclical stock price relative to earnings. So you want to be a little bit careful with these. Every now and then it kind of gets ahead of itself when it gets up to like this 25 PE level. But over the long term, this has been one of the better performing stocks since it went public, I think back in about 99. So I bought it. Let's go ahead and zoom in. More recent time period here. I bought the stock not super deep into that March decline. It was on the 9th. I went and double checked. And I sold almost all of my financial stocks right up here near where it peaked. But I decided to hold on to Blackrock and I think one other bank for the long term. But most of these I sold here. And I thought I sold Blackrock, but I'm glad I went back and checked because I didn't sell it until it bounced back off of this initial bottom here on about December 8th or 9th is when I sold. But bought it here, sold it there. That was about an 80% profit in, less than 2 years. So I did fine. And soon after I sold, the stock price fell. I sold about 700. It fell all the way below 600 that next year. Now it's bounced back really strong since then, but it was weak as expected, I think. And so the question is now, the thing with Blackrock is they have a lot of like ETFs and passive investing. I think they also have some active stuff. So it's a lot of their earnings are going to depend on how the market's doing. And we haven't really, we did have a bear market in 2022 and we saw earnings per share fell 10%. I think earnings could honestly fall like 30% in a recession for these guys. And I think the stock price could fall 65% probably in like a solid recession. Kind of depends on where it was. It still hasn't reached its previous high. Oh, yeah. Yeah, 973. So, yeah, it still hasn't recovered its high back in 2021, the end of 2021, but it's getting close. So for me, I would keep in mind that earnings can decline more than this time period that I'm using here. And I'll give you a couple, but the kind of the interesting thing is, like, even when you account for like a decline, a crash like this, which is what I'm going to do when we look at the numbers, it has about the same buy price as if you just did a straight up kind of earnings analysis. So during this period, earnings haven't really grown that fast. They've grown about 8%. My earnings growth rate will be lower than that. I take into account this earnings decline here. I take into account the earnings decline here. And I take into account any buybacks that they've had over this period. I don't remember exactly how much they were now, but my earnings growth is actually going to come in between like 5 and 6% instead of 7, in between 7 and 8, so a little bit more conservative. So this isn't the same kind of growth company that it was 25, 20 years ago, even coming out of the Great Recession. But they are kind of like best in class in turn. Like, I think they're definitely going to still be taking some market share from like its heroes and the Ben Franklins of the world. And I think ETFs are definitely going to keep eating away at mutual funds that people still have. So there's still room. I think there's still room for these guys to grow. I'm not too worried about them not being able to grow. I just don't think it's going to be at a super fast rate. So yeah, I have my earnings growth rate about 5%. If we assume that, now revenues, the 3-year revenue number is actually negative, and that's because of the boom bust, right? So the revenues probably peaked about 3 years ago, and now they're just getting, after dipping, they're kind of just getting back up to where they were. So I'm not too worried that this is like a permanent kind of revenue decline. Like, sometimes I would sell a stock if it, just because of that revenue trend, but it's actually now trending back up again. So I don't think it's like a permanent thing. This is part of the boom bust and the bear market of 2022. And you can see that they are sensitive. Their revenues are sensitive to what the market's doing, and now the market's back up to like all-time highs, and this is back up. Revenues about back up to where it was when it was at an all-time high. So this looks probably worse, I think, than it really is for them, unless we have a recession in the next year or two. So I'm not too worried about that, but I do think this 5, anywhere between like 5 and it depends on what inflation is going to be. But if inflation is if inflation is 3%, I mean, this could be more like 6 or 7% earnings growth, but I'm just going to stick with the 5 that I have here. And so the way that I do this is, they don't really have much debt, so I don't have much of an adjustment. Stock price is $936 right now. I'm treating it as though it's $955, just because of the small amount of debt that they do have. That produces an earnings yield, which is the inverse of the PE ratio. So it's earnings over price of 4.35%. So that's what I'm going to use to calculate my valuation. So the way I like to think about it is, if I bought the business for $100, it would earn $4.35. And if I pull the first year forward, so I assume the first year it would earn $4.57, and then that $4.57 grows at 5% each year for 10 years, and I want to see how much I would earn on my $100. And I would earn about an extra $58, we'll call it. It's $57.69 on my $100 investment after 10 years. So that CAGR that works out to is only 4.66%. That's below like the 5% kind of threshold that I would use as kind of a selling threshold potentially. Now, maybe my earnings growth estimate is probably a little lower than what the market is. Like, if I put 7% in here, it's probably going to be about, the market's probably actually pricing about 8% earnings growth. I didn't look and see what it was, but we can go look and see if I'm right. Usually I have a pretty good read on, my system's not all that much different from, okay, so it's even more. So 10% this year is what, and then 12 and 15. So if we did, let's say it's 12. Let's see what 12 would work out to. The market tends to look more short-term forward, and Yeah, that would be like fairly valued if it actually does bring in 12% real earnings growth for the next decade. I think that unless we have high inflation, that's probably optimistic. But also, if we assume that there's a recession, there's danger of that as well. The Fed started lowering rates because the economy's slowing. Doesn't necessarily mean it'll be a recession or a bear market, but it could be. But when we put all that together, I like to buy it if this CAGR is 8% or higher, which is what happened back in March probably. I had a slightly different system I was using, but similar. So it does get that cheap sometimes. And then if we use the 2020 drawdown as a guide for a future potential drawdown, both those are pointing to a buy price that's about 58% lower than where the stock price is right now. Right around $390, give or take. So maybe a little under 400 would be where I would look to maybe be buying it again. When was the last time it was down there? Didn't get down there. It's been a while. Yeah, didn't get down there until like 2020 was the last time it was down there. So, but if you look at the PE, like it traded down at a 12 PE, right? Back just in 2020, not like an extended recession. That was like very brief crash. And right now we're at a PE that's almost double that. So you would think, okay, well, that's reasonable that the stock price could fall that much if there's another like recession, right? And if we go back, now remember it was growing a lot faster going into, it grew 53% in 2007, right? And so it had a lot faster earnings growth going into that decline, and it still traded down to a 14 PE. And then in 2011, again, it's down below a 13 PE, right? So when was the lowest? Yeah, so to think it could get down there again, I think during a recession is pretty reasonable, or even just a bad bear market. And I also think that their growth potential, 15 years ago was much higher than it is now because they've already grown quite a bit. So it's definitely high enough quality that I would buy it at the right price, but and if a person wanted to buy this one and hold it for the long term, which actually is initially what I had decided to do, but things had weakened so much, the earnings had already fallen when I sold in late 2022, it looked like we could actually have a real recession on top of the bear market, and stock price, like I said, did trade lower, but I decided to go ahead and take profits because it looked like that was going to happen. But then we had like the AI boom, and it kind of brought a lot of more money into the market, and that brings more money to Blackrock, and now the Fed's lowering rates, so maybe we'll get away without a recession here, but we'll have to just wait and see. So yeah, that's my kind of at the right price around right now. Now, of course, as earnings rise, that buy price will rise as well, and they've almost reached their peak earnings in 2021, so the recession buy price would rise with that as well. So as they do better, those buy prices will increase. But yeah, I mean, 58% lower is probably what it would take to get me back in again, because it is risky, it is volatile. If you want to make really good money, then buying cheap is good. Like I was able to make 80% in a year and 3/4 or something like that. So I mean, if I went back here to when somebody paid 23 PE in 2018 for it, they would be making like 97% over that much longer time period, right? So you don't have to own it as long if you buy it cheap enough. I guess if I sold in 2022, I held it a little bit longer than that, right? 1, 2, yeah, so 2 3/4 years instead of 1. But still, 80% return without having to hold like a really long time in order to get an 80% return. So I think if you buy now, you can still get it, but it might take 6, 7, 8, 9 years, right? Instead of 3 or 4 or 5 type of thing. All right, thanks for watching. If you found this useful, hit the subscribe button, hit the like button. If you have a request, let me know, and I'll see everybody later. Bye.